Today, we will talk about a gift of equity, what it is, how it works, taxes, and pros and cons. A gift of equity is the sale of a residence to a family member or someone with whom the seller has a close relationship. It is sold at a price below market value, with the difference between the actual sales price and the market value of the home being the gift of equity. Most lenders allow the equity to be used toward a down payment. When someone gives a gift of equity, they are giving someone value in a home by selling it for less than its true market price. For example, if a home is worth $300,000 and is sold to a family member for $200,000, the gift of equity is $100,000. Buyers must still qualify for a mortgage even with a gift of equity, meeting the lender's requirements regarding credit scores and income. Sellers also need to consider what they're walking away from with a gift of equity, as they may be helping a relative purchase a home but could lose an opportunity to reap a sizable profit. The most obvious benefit of using a gift of equity is that the buyer doesn't have to secure a down payment, as the gift of equity can be used as a down payment. This saves the recipient time and money, especially considering the minimum down payment for an FHA mortgage is 3.5%. A gift of equity requires a gift of equity letter, signed by the seller and the buyer, stating the facts of the sale. The letter must note who is offering the gift, the amount of the gift of equity, and the property in question, attesting that it is a gift. A lender usually considers gifts of equity as part of the down payment required to qualify for a mortgage. For example, if a bank requires 20% down, but the gift of equity made by the seller equals 10% of the home's value, the buyer now only needs to make a down payment of 10% of the property's price. A gift of equity involves transferring part of a home's value as a gift, while a cash gift is a direct transfer of money. Both can help a loved one purchase a home, but a gift of equity is specific to real estate transactions. Yes, a gift of equity can be part of estate planning, permitting homeowners to transfer property to family members or other loved ones while still alive. This could potentially reduce future estate taxes and ensure that the property remains within the family. Gifts of equity could have tax implications for the seller, depending on the size of the gift. The seller may have to pay a gift tax unless the gift of equity is lower than the annual exclusion. Yes, for the giver it can have tax implications, count against the annual gift tax exclusion or the giver's lifetime gift tax exemption. A gift of equity is not directly taxable for the recipient but could incur higher capital gains taxes later on. A gift of equity is a way for a seller to help buyers, usually family members, purchase a home. It involves selling the home below market value, effectively giving the buyer immediate access to more equity than they paid for. Here are 5 key takeaways. 1. A gift of equity involves the sale of a residence at a price below its market value without exchanging money. 2. A gift of equity usually involves family members or others close to each other, such as parents selling their home to a child. 3. Most lenders allow the gift to count toward a down payment on the home. 4. Gifts of equity must be properly documented through a gift of equity letter, and the home buyer must qualify for a mortgage. 5. Gifts of equity typically have tax implications for the giver and the recipient. Hope this would help. Thanks for watching.